Hello and welcome. The material for today's deep dive into Canadian employment income tax has been prepared by Dr. Samir Al-Rashani with AI support. Our goal here is to make this complex topic as clear and understandable as possible.
So let's get started. We're going to demystify a subject that, let's face it, impacts just about every working Canadian: employment income tax. We're going to break down the rules that figure out what you earn, what you actually get to keep, and what gets taxed. And we'll be drawing directly from the sources of Canadian tax law to do it.
All right, here's our game plan. First, we'll look at where our tax laws even come from. Then, we'll dive into a really big one. Are you an employee or are you self-employed? After that, we'll explore what I call the 4 pillars of income, decode the very tricky world of taxable benefits, clear up the confusion between allowances and deductions, and finally, we'll wrap up with some key financial limits you absolutely need to be aware of.
Okay, so first things first, we need to understand where the rules of the game actually come from. You see, in taxation, the law isn't just one single book. It's really a collection of different authorities that all work together, and knowing what they are is the foundation for understanding the whole system.
So here they are, the 5 key sources shaping Canadian tax law. You've got the big one, the Income Tax Act, which is the main law written by the Department of Finance. Then there's common law, which is basically law made by judges through their rulings in court. The CRA, or Canada Revenue Agency, is the group that actually enforces all these laws. And of course, we have tax treaties with other countries. Now here's the most important thing to remember. There's a hierarchy. If a tax treaty ever conflicts with our own Income Tax Act, the treaty always wins. This is super important for preventing things like getting taxed on the same income in 2 different countries.
Now, let's move on to one of the most fundamental questions in all of tax law. Whether you're an employee or a self-employed contractor isn't just a job title. It completely changes how your income gets taxed, right from the very beginning.
So how do you really know which one you are? Well, it's not always as simple as what it says in your contract. The CRA and the courts will actually look right past the paperwork. They apply a series of tests to figure out the true nature of your working relationship. Let's take a look at what those tests are.
This table breaks it down perfectly. These are the 4 tests the CRA uses. First up is control. Who decides how the work gets done? An employee is told what to do and how to do it. A contractor, on the other hand, has a lot more freedom. Second, ownership of tools. Does the person provide their own equipment? Think about a mechanic who brings their own expensive tools versus one who just uses the shop stuff. That points toward being self-employed. Third, the profit and loss risk. Who's on the hook financially? A contractor carries the risk if a project goes south, while an employee gets their salary no matter what. And finally, integration. How essential is the person's role to the main business? If someone's wearing a company uniform, driving a branded van, well, they're highly integrated, and that screams employee.
All right, so once we've figured out that someone is an employee, we can start calculating their income for tax. And to do that, we have to understand the 4 core components. Think of them as the building blocks that make up your total employment income.
So as you see, the 4 pillars are compensation, benefits, allowances, and deductions. It is absolutely vital to keep these separate. Why? Because the government's goal is to tax all forms of value that move from an employer to an employee, and the Income Tax Act treats each of these pillars differently, which has a direct impact on your tax bill. Let's break down what each one actually is.
Let's get these terms straight. Compensation is the easy one. It's your salary, wages, your bonuses. A benefit is a non-cash perk you get, like using a company car for personal trips. An allowance is a fixed chunk of money for a specific purpose, like a $500 monthly car allowance. And a deduction is an expense the law lets you subtract from your income, like union dues. Now here's the critical part. Benefits and allowances usually add to your taxable income, while deductions subtract from it. That difference is everything.
Okay, let's zoom in on taxable benefits, because this is honestly where things can get a little tricky. The Canadian tax system loves to operate on a rule and exception model, and you see this all over the place when it comes to employee benefits.
The basic rule is actually really simple and really broad. The Income Tax Act starts from a default position that says any advantage, any perk, any benefit you get because of your job is taxable. It doesn't matter if it's an item or a service, its fair market value has to be calculated and added to your income. That is the starting point for absolutely everything else.
This slide really shows that rule and exception model in action. Over on the left, you see things that are pretty clearly perks: holiday trips, big gifts, cheap loans. Those are taxable. But on the right, you have things that are often tied to your health and well-being, like private health plans or counseling. As a matter of public policy, the government has decided these specific benefits are non-taxable. One interesting one on the taxable side is group term life insurance. Even though it's a group plan, the premium your employer pays is a taxable benefit to you.
Let's walk through a very specific, real-world scenario to see how this all works. Imagine your employer transfers you to another city. To make the move, you have to sell your house, and you end up losing a lot of money on it. To help you out, the company reimburses you for that loss. So is that money taxable? The answer is yes, but only a part of it, and the calculation is very, very specific.
So how do we do the math on this? Let's say you lost a big chunk, say $200,000 on the sale of your home. The Income Tax Act has a special rule just for this. The first $15,000 of the money they give you back is totally tax-free. For anything they reimburse above that, only half, 50%, is considered a taxable benefit. So we take the $200,000, we subtract the tax-free $15,000, which leaves $185,000. Then we take half of that, which gives us $92,500. That's the number you have to add to your employment income for the year.
And just to really drive home the idea of exceptions, here are some other common benefits that are usually not taxable. Things like discounts on company products, as long as they don't sell it to you below cost, or cheap meals in a staff cafeteria, or using a cell phone that's mainly for business. The logic here is that these benefits are often for the employer's convenience, or are necessary for you to do your job, not just a way to sneak you extra pay.
All right, next up, let's clear the air on two things that get mixed up all the time: allowances and deductions. It is so important to get them right because they work from completely opposite starting points in the eyes of the tax man. So here's the bottom line. The default rule for an allowance is that it's taxable. You have to include it in your income unless a very specific exception in the Act applies, like a reasonable travel allowance. Now for deductions, the default rule is the complete opposite. You are not allowed to deduct any work expenses from your income unless that expense is specifically permitted by the Act. See? They're mirror images of each other.
And here is some of those specific permitted deductions. You can deduct mandatory professional fees, like for engineers or accountants, and union dues. Contributions you personally make to a registered pension plan or RPP are also deductible. You might be able to deduct the cost of supplies you use up in your work. Think of an artist buying their own paints. And finally, you might be able to deduct home office expenses, but you have to meet really strict conditions for that, like your home office has to be your main place of work.
Okay, for our final section, let's look at some of the hard numbers. The Income Tax Act doesn't just say what you can deduct. To stop people from going overboard, it often puts specific dollar limits on those deductions, no matter how much you actually spent.
This table lays out the key limits for vehicle expenses. When you calculate depreciation for tax, what's known as capital cost allowance, or CCA, the most you can claim for the value of the car is capped at $34,000 plus tax, even if you bought a much fancier car. If you've got a car loan, the max interest you can deduct is capped at $300 a month, and if you lease, the maximum lease payment you can deduct is $900 a month plus tax. Anything you pay over these limits, you just can't deduct it. Simple as that.
And here's another famous one, the 50% rule for meals and entertainment. When you spend money on these for business, you can only deduct half of what you actually paid. The government's logic is basically that everyone has to eat anyway, so there's always a personal element to it, even if it's a business meal. So, you take a client out for a $100 dinner to talk business, you can only claim a $50 deduction.
And one final, really crucial detail that is so easy to miss. When your employer figures out the value of a taxable benefit to put on your T4 slip, they have to include the full cost, and that includes any sales tax like GST or HST that they paid. So, if your company pays for a gym membership that costs $500 plus $65 in HST, the taxable benefit you have to report isn't just $500, it's the full $565. It's a small thing, but it directly increases your taxable income, and it can definitely be a surprise if you aren't expecting it.
So there you have it. We've covered the legal framework, the huge difference between being an employee and a contractor, the 4 pillars of income, and the specific rules for benefits, allowances, and deductions. With all that in mind, I'll leave you with a question to think about. Which part of your own pay, maybe it's a benefit you get, an allowance, or a deduction you might now be able to claim, which part will you look at differently now?